The compound nation has turned out, Michael. I'm looking at the chat. It's going crazy right now. Everybody's here. Do you want to know who's here?
Is Jay Luther here?
I didn't know if I saw him yet, but JD roaring on 20s. Chris Hayes, Kenyon LaPierre. Alex Galvez is here. Dave Wilson, Akbar Muhammad. Stock Market Mike, what up? Simon East. Everybody's here, dude. Zoe's here. Donald Brenner. Bob Rice. The whole Roger's here. The whole crew. Okay. Hey, guys, we have an action-packed show tonight.
Oh, my God.
This is one of those weeks where last week so much happened, and then later this week so much is about to happen. And we're going to get to all of it. I want to tell you about our very special sponsor. You know this company at this point. You love them. It's Rocket Money. Michael, what does Rocket Money do?
Can I just ask a question? Hold on. Before we get to Rocket Money, which is not just a sponsor, it's a way of life. It's a way. It's a way of my life. I get updates daily. Are you watching the Menendez Bros?
Oh, I'm all in.
Oh my God! What episode?
It's not my typical cup of tea.
I'm surprised that you're watching it. What episode are you on?
Obsessed. 4.
Okay, it's wild.
I might cry. The problem is football last night. Chiefs, amazing game.
Not an amazing game. Not even close to an amazing game.
I love watching greatness, so I celebrate greatness. So every game Mahomes plays in is greatness for me. What the hell is that?
I don't know.
Oh,
I just held it weird, and they got it on my shirt. All right,
it's hard to get to anything besides football during football season.
I got you. All right, this is just gonna be here the rest of the show now.
Charles just said Menendez Brothers is that shit right now. It really is. It's you know when they had me, the pilot. They're playing all the music from when I was 13 because it takes place in 89 and 90. They're playing it's not. I don't listen to this music now, but
Vanilla
they had
Ice?
a banger from Milli Vanilli to open the show, and Vanilla Ice and Snap. I Got the Power. These are music I haven't heard in 40 years. It's so much fun.
Okay, so anyway, speaking of fun, Rocket Money, lots of fun. If you, like I do, have subscriptions up the wazoo, and you're like, wait, what am I paying for? How do I cancel this? Boom. You can do it right inside the app from Rocket Money. I say this whenever we have Rocket Money on, but it's true. I get large transaction detected. Wait, what's this? What? Robin, did you just go to J.Crew? Yeah, okay. I get the refunds.
So not just subscriptions, everything.
Every time there's a large transaction, I get an alert. Every time there's a refund, I get an alert. I love it. Love it, love it, love it.
Well, is there a specific URL that we can tell people to go to?
Wow, we have 35 pages in the doc today. Yeah, you gosh damn right there is. Rocketmoney.com/compound. That's rocketmoney.com/compound.
Stop wasting money. Okay. All right, so let me set this up. Last Friday, we had the BLS report, September non-farm payrolls, and it was a massive upside blowout surprise. The most notable reaction has not really been in the stock market per se. The action has mostly been in the bond market, which, if you think about the mentality of the bond market, they were all set up for this economic deceleration where they know rates are coming down, the economy's slowing, inflation is more or less under control. But this economic deceleration really doesn't want to come easy. And we immediately had higher intermediate term yields in the Treasury market. And then that kind of hit the stock market negatively yesterday. You got a 400-point Dow Jones sell-off while the 10-year raced up to 4%. And I guess this was not priced in, so to speak, in advance.
To what? To the stock market? Into the stock market? Because Friday, the day of
commentary, even.
The day of, so Friday, yes. Well, the move was in bonds. We're going to get to that in a second. But the stock market was at 1% close to an all-time high. We gave some of it back yesterday, but we took it all back today.
Yeah. No, I'm just saying people were like, wait. What? I have to change my whole mentality now.
Well, when we got the data that morning on our channel, we were saying I'm curious to see how the market closes today. Right? Yeah. Because how much of the stock market's gain year to date has been looking forward to rate cuts versus being driven by it's a good economy, we've got good earnings, and it looks like luckily the stock market wasn't, what day's a day? Friday, it wasn't just counting on rate cuts, which is great.
Yeah, you know what? It's not good or bad. It's like a monkey wrench thrown into the narrative. That's all. People had to All right, let me put it this way. People that were like, yeah, they should have done 50 basis points were actually pretty quiet. Right? Like it was just like a little bit of a narrative shift. Like, oh, wait, maybe things aren't decelerating to the degree that we thought they were in August. Okay, Chart Kid Matt put together a couple of things here. Just
wait, Josh, can I just pause just for a sec? Just for the audience. I know you've been seeing our charts. I just want to give a special shout to Chart Kid Matt, who went crazy for tonight's show. Wait till you see the charts that we've got cooking.
Yeah, and if you feel like we're glazing this kid too much, it's probably not enough. His charts are His charts are all over our stuff, and it's like a huge step change improvement in everything that we're doing. All right, let's do this first one. Yield curve post NFP report. Somebody's saying bring out Matt. Not yet.
I mean, I can't believe what you just said, but okay, what are we looking at?
This is the yield curve following the NFP report, and we're showing you like 1 month, 2 month, 3 month, all the way out to 30-year. And you can see the red cross back over the blue when you get out 6 months. And I think what's interesting here is probably the 10-year from my perspective. This was supposed to be much more subdued by this point. We've already had the first rate cut, and it was a 50. And we've like all kind of settled on this idea that there's still growth. The consumer is hanging in there, quote unquote, resilient. But 25 is not really going to be anything like 23. And it just like refuses to cooperate. And if you look at the arrows, you can see like where the real action is.
Look at those moves, like big moves in the bond market. I asked Matt to do a daily chart, but if you look at a weekly chart too of the 2-year, we had the biggest weekly climb in 2-year in terms of basis points. And on a daily basis, even still it stands out. So the narrative that the economy was decelerating definitely flipped on Friday for sure. And the futures market reacted in terms of how many price cuts were the market is expecting. Next chart, please. So here, the gray line is a Fed funds rate. It's the upper bound, which is where we are today or where we've been. And the light blue line is before the jobs report, what the market was pricing in terms of forward rates. And you see that it shifted dramatically higher after the jobs report based on the strength. So maybe the market doesn't need or the Fed doesn't need to cut as many times as the market was suggesting.
So like if you look at like January 2026, so like out 18 months or whatever.
Yeah, big move.
Right. They were thinking like we could be sub 3%. And now they're not thinking that we're going below 3% as the terminal cut as the terminal level in this cutting cycle.
I guess also like take all this with a grain of salt, right? Because these are just predictions. These are just predictions, and it moves all the time as new data comes into the market.
Yeah, I think that the action yesterday was maybe not so much like fear of a 4% 10-year, but just like maybe a realization that some of the appeal based on rate cuts maybe had to come out. And I don't think that, and I know we got it back today, I don't necessarily think that it's like a narrative that we all agree to. I just think it's like a lot of individuals all acting on their own and just maybe taking a little bit of profits. I mean, last week was an amazing week. And the week before that was pretty good. So it's like, to me, it's just like a little bit of air coming out, but it's not. This is not a trend change.
This is a lot of noise. What we're saying, people took profits yesterday and bought it back today.
Yeah, I don't know.
I mean, come on, what are we doing?
Somebody did. At least one person did. I'll tell you that much. All right, let's take a look at the stock reaction. This is the 10 best and 10 worst performing S&P 500 stocks on the day of that blowout earnings report. Listen, I would not create an investment strategy based on this, but it's good to know where heaven and hell is if we're not quite going to get as many rate cuts as we thought. Like it's good to have some sense of what they're going to throw. So look at how many home builders were in this bottom list of the biggest decliners. And it's not like those charts are broken because I looked at them, but that's what people were willing to sell when they thought that we would get less rate hikes than prior expectations.
It's so weird to me that, I know that's not the topic here. It's just so weird to me that the home builders are consumer discretionary.
Why? Like they should be. What should they be?
I don't know. I know real estate is REIT, so that's it's
the industry is household durables, and those are the houses themselves. That's what's weird about it.
Again, put the chart back on. So in terms of the negatives, yes, the home builders all got whacked. But I mean, look at the run they've been on. You know what I mean? Like these are some of the best performing stocks in the market. So I would view that as pure noise. On the flip side, the best performing stocks and things that stood out to me are Discover and Capital One, and that's pure consumer.
Throw United Airlines in there, and Norwegian Cruises, so that's pure consumer too.
Yeah,
I'm with you on that. All right, this is Neil Dudda's reaction. He sent an email out, and the subject line was all caps. Wow. Period. Good number. This is what he had to say. NFP Friday overwhelms all other employment indicators. Thus, the simplest reaction to this morning's employment report is that labor market conditions are so strong that it makes a 50 basis point rate cut unlikely at any remaining meeting this year and reinforces the Fed's 25 basis point guidance between now and year end. Labor market conditions are not slowing as materially as we thought. Bond markets are repricing on the news as less recalibration is needed to stabilize the economy. For the equity markets, it is undeniably good news. At the end of the day, the Fed is still cutting policy rates even as the economy grows. Okay, that's my big takeaway. Also at Renmac, technician and our friend Jeff DeGraff, yields are in their first overbought condition since April of this year off the impressive payroll print on Friday. The spike in yields did not dissuade equity investors as cyclicality led and took stocks higher with defensive and interest-sensitive names lagging. That's exactly what we just showed you guys. We view that bullishly as it implies equities are not overly reliant on the benevolence of the Fed cutting rates.
It's beautiful.
What else? One last thing he said. Our market cycle clock entered the bullish zone for October, but as interesting is that this zone tends to favor cyclicality over defensive names. We're not seeing it in discretionary names versus the broad market yet, but we are seeing discretionary outperform staples with a new relative strength high. So the up economy trade basically worked. You didn't quite get the discretionary outperforming the market, but they beat the staples. So there's belief that what we just got on Friday is part of something sustainable and not something anomalous. I guess would be the big takeaway.
I was just punching up a chart of RSPD divided by RSPS. This is the consumer discretionary equal weight, because if you use XLY, it's like 40% Tesla and Amazon. So the equal weight discretionary divided by equal weight staples is ripping.
Michael, was 50 basis points too high in light of September labor market strength?
You know, you and I spent too much time together because I said to Ben today, Ben, Bill Simmons' voice, are we sure the Fed should have gotten 50?
Yeah.
Okay.
What did he say?
He said no, and I would tend to agree with him. It's a fun discussion, but the reason why I still think 50 was appropriate is look where the 2-year yield is compared to the Fed funds rate, number one, and look where inflation is. So, 50 basis points was still appropriate.
What would it take for the Fed to not cut in November? So right now we're saying 25 basis, we're saying 25 basis points. What would make them not do that? What could happen between now and then?
Well, we have another inflation and PCE number, right? And we've got another report. So if those
you have October NFP, first Friday of November before, and you've got CPI, no big deal tomorrow.
So 2%?
That's what it would take. Yeah, like a wild number on something like shelter or labor costs.
I think it would have to be such a downside surprise for them to
upside surprise.
No, downside in terms of inflation.
Oh,
below
what?
I'm saying if inflation came in so far below expectations,
Oh, well, then they're still cut. We're asking what would make them not cut.
What would make them not cut?
Yeah, they are cutting. Expectation is they are cutting. What would stop them? Like a red hot CPI, red hot
but that's not,
employment report.
But that's not going to happen. A red hot CPI number?
You didn't think Friday was going to happen? I didn't either.
No, but a red hot CPI number? That'd be so odd.
But the readings are so odd. They're
no. But CPI is not volatile like that. Like it's not going to come out of nowhere. No, they're cutting.
Okay. Bank of America U.S. economist Aditya Bave says the bar is pretty high to avoid cutting, meaning most likely they're cutting. Let me read to you what Bave has to say. The gangbusters September jobs report and the large upward revisions to GDP and GDI suggest to us that the Fed's supersized 50 basis point cut in September was not warranted. Client conversations have quickly shifted from will the Fed cut by 25 or 50 in November to does the Fed need to cut at all in November? Or will the Fed skip November to make up for the 50 it already did in September? That's interesting, right? It's an idea.
If inflation is at 2%, why do overnight rates need to be at 4.5? Especially
correct.
when the housing,
unless you think they're going to go back up.
Especially when the housing market is still frozen. Especially when you have mortgage rates going up, they need those numbers to come down now.
Recraw in the chat is saying, didn't they make up for missing July by doing the 50?
Yeah, that too.
August? I think
yes.
I think so.
Yes.
Oh wait. Even if the Fed concludes with the benefit of hindsight that it didn't need to cut by 50 in September, we doubt it will be deterred from cutting based on strong labor data alone. Governor Waller said as much in his recent comments. As long as the Fed feels comfortable that disinflation is on track, it can keep cutting rates. So to your point, but inflation is top of mind once again. All eyes will be on the Thursday data. We are above consensus at 0.3% month over month on the core CPI, but the core PCE should be more benign at 0.2. That's probably soft enough for the Fed to cut by 25. All right. Let me show you a chart really quickly of core PCE and housing. So this is the question, and this is B of A. Inflation looks much more benign if one is willing to look through housing. Can the Fed look through housing?
Yes.
Because if you just look at core PCE x housing, there's not really much to be worried about in terms of the trend of inflation. I mean, the housing component is still elevated.
Rents
and it might be elevated for a long time.
Rents are coming way down. They're going.
Yeah. Okay. Ed Yardeni has a piece out, which we're not going to do a whole thing about right now, but he disagrees. He says we might have seen all of the cuts we're going to see this year, and his piece is called 12 Reasons for None and Done. And I'm not going to read the whole thing, but I just want to give you a couple of the headline reasons that he cites, and you can probably imagine the commentary. Demand for workers, supply of workers, aggregate hours worked, hourly wages and earned income proxy. The economy didn't need the 50 basis points. Fed officials should now be having regrets that they did that much.
No, but the housing market needs it very badly.
The backup in bond yields since the Fed started easing on September 18th is signaling that the easing wasn't necessary and increased the possibility of even stronger economic growth or higher inflation. 4, further cuts would raise the odds of a 1990s-style stock market melt-up. They don't want that.
Let's do it.
5, oil prices are rising because of mounting geopolitical risks in the Middle East. That's reminiscent of the 70s-style stagflationary scenario, right? You would not be cutting into that. 6, cleaning up and rebuilding following Hurricane Helene will be stimulative and possibly inflationary. 7, the dock workers' recent huge pay settlement could raise import prices and put upward pressure on other unions' wages. 8, both presidential candidates are proposing inflationary fiscal programs. 9, the Chinese are stimulating. 10, further cuts in Fed funds might weaken the dollar, which is inflationary. 11, As Governor Bowman said, the Fed has not fully accomplished its mission. 12, the neutral Fed funds rate might be much higher than reflected in the FOMC summary of economic projections. So those are 12 reasons that might give them pause, and we might already be done for the year. You don't think so?
No.
Okay. Well, that's the debate. I wonder how the market would react if the economy is so good the Fed doesn't have to cut. Do we buy or sell?
It's like the scene. It's like the scene in Princess Bride, right? Like you just keep going round and round and round.
It's like,
dude, I don't know.
Like, hey guys, good news. The economy's stronger than we thought. Yeah, but I want the medicine.
Right.
But
no, you don't need the medicine. You're good. No.
But I was investing based on it.
Yeah. Yeah.
All right. So that's what's going on there.
I don't wait. Hold on. No. I don't want to let you off the hook. What do you think the market would do? I think the market would shit a brick.
I think so long as wage gains stay under control and the labor market's in stasis, I think it would be okay.
If they pause, you think the market's okay?
You probably have one really nasty day, and then we come back in and buy them.
Yeah, I agree with that. That's exactly what I think.
Yeah. Katie Greifeld tweeted the re-inversion. This is some weird shit.
I didn't even see this. I can't even see this on the data. Go ahead.
You have to use a magnifying glass, okay. But the 2s and 10s re-inverted on this news.
All right. Well, they disinverted again, so we're good.
Let's look at the 10-year, 2-year spread. You could see it on here. Chart Kid Matt, well done. You could see this brief spike above. This is the 10-year, 2-year spread closed at 0% on October 7th, and then went back positive on October 8th, which is today.
Recession avoided.
Recession avoided by 0.06 basis points on the 10s, 2s.
Beautiful.
So,
okay.
All is well.
I want to talk about a topic that we don't spend a ton of time talking about on this show, but I think it's really important. Then Ryan Curlin tweeted about it, and I thought it was worth talking about. Okay. He said, quote, I want 4 to 5% income portfolio for retirement. Many people then go to dividends, high-yielding corporates, et cetera, to try and achieve this goal. I get it. It feels safer. If I just don't have to touch a principal and can only use the distributions kicked off, I'll be safe. Ryan says, if you want to give yourself the highest chance at maintaining a 4 to 5% withdrawals, I believe the safest way to do that is to ensure you have proper diversification, manage your costs, manage your taxes. Trying to create an income portfolio where you never have to touch the principles like playing prevent defense in football or trying the 4-corner strategy in basketball. You need balance in your strategy. Okay, completely agree with him. Doesn't matter. People love income. The market, the heart wants what the heart wants, for better, for worse. People fucking love income. And I get it. So there was an article in the journal, in Bloomberg, I apologize, talking about the explosion of derivative-based ETFs, primarily with high income. So they said there's been a record 164 derivative-based launches in the U.S. so far this year. Some firms have filed to start as many as 25% at a time. The assets have grown 6-fold in the past 5 years to $300 billion. Chart on, please. So just an explosive growth.
These are derivatives-based ETFs. So these are like, are the buffers in here?
Yes.
What else is in here besides that?
Anything in here that uses swaps or options.
Ops.
I would guess all of the single stock stuff is in here. So here's one that's in here. So again, next chart. Just the number of launches is crazy. There was a rule change that allowed for ease of access into these things. So there's a company called YieldMax, which is an issuer that works with title. They've amassed more than $4 billion in assets in less than 2 years. So they've got 10,000 people on their Reddit community engaging. So one of their strategies, the YieldMax coin option income strategy, has sent more than 100% of its current share value back to holders as cash in the past year. Yet thanks to a swoon in the ETF's price, it's actually down on a total return basis so far in 2024. So here's a quote from a guy in the article who's dabbled in these things. This guy, this 57-year-old, he said, investors need to utilize caution when they read about double-digit distributions on a monthly basis. Understand how the covered call funds work. In my case here, the net asset value totally eroded away. Luckily for me, it was only 1% of my portfolio. I call it my collateral damage. So I punch this up on Y charts. Con Y, the YieldMax coin option income strategy.
I'm sorry, Michael, this is it tracks Coinbase, but it sells options to capitalize on the volatility of Coinbase.
Yes. So chart
So
back
how
on.
do you
So
get
look
a
at this.
drawdown? How do you get a drawdown in this?
Look at this. The dividend yield is 161%. Unbelievable. Assets under management, $640 million. If you, John, next chart, please. This is the assets under management from the inception to today. So the point is, people love high income. Love it. Can't get enough of it.
I'm gonna tell you a story. The year is 2005. The hottest trade on earth is emerging markets, and one of the hottest ways to play it for U.S. investors is the shipping stocks. And there are about 10 or 12 of them. And they trade on the American Stock Exchange in some cases, and they have really shady management and corporate governance. It's a lot of Greek people that are not Americans. That
What
are
were the
sitting
names
on
of
the
these
boards.
stocks?
These are like, it'll come to me. But the point was you bought them because they had obscene nominal dividend payouts. Yeah, John Carlos says dry ships. DRYS.
Was it
That's
DRYS?
right.
Yeah.
That was a biggie. A lot of them are bankrupt, and they go. And the thing is, you had to be an old soul to have remembered the 60s, 70s, and 80s where these were popular, and they were going bankrupt on a regular basis. And so we had like 10 or 12 of these things, and they'd be called like Star Shipping, blah blah blah. Every single one of these had somebody named Georgopoulos as like the chairman or the CEO.
Right.
And I think it was all one person. And they were like a darling because they had these like 70% dividend yields. And everybody knew like it's not really going to pay out 70 because the price is so volatile and the profits are so volatile. The dividend goes up and down also. But like they were all unsustainable yields. And we used to go to these conferences in Manhattan. They would rent out the Pierre. They would feed like 400 brokers, and they would like go on stage and tell you about all the new ships, and they're buying new builds, and they're doing this, they're doing that, and they would all just go to zero. And the reason why they were so popular was not because anybody cared about global shipping or the dry bulk index. It's because of those crazy dividends. So people have not changed.
Yeah.
It's just a different way of getting the same thing. People love high payouts.
So when these things get paid out, the net asset value of the fund goes down. So that's how you could have 160% stated yield and still potentially negative returns.
How does a fund like this Coinbase YieldMax Coin Option Income Strategy, which I literally have never heard of until just now, how does something like this amass $640 million? That's like, dude, that's real money.
Yeah.
But most ETFs that have real money in them are not retail. They're advisor-driven flows.
This is retail.
This has got to be all retail, right?
Yeah.
If a financial advisor puts you in this, they need to be arrested immediately. Like somebody has to come crashing through the window, right? Or is that overstating the issue?
I don't know. I mean, that's a bit harsh, but anyway, the point is this: Ryan's 100% right that you need to think about the overall portfolio. Stop being so freaked out about dipping into principal. Like that's what a balanced portfolio could do for you. Nevertheless, doesn't matter. People love high income.
One thing, you know what they hate? They hate when you tell them, as many advisors had to during the free money era of, let's call it 2002 to 2022. There's a 20-year period where advisors basically had to be like, I can't get you 4% in current yield. So if you want 4%, I could get you 2.5%, and then each year we're going to have to sell some stocks off to equal a 4% withdrawal. And people did not like it. They really, really, really disliked it. Almost to the point where they said, you know what, I don't even want the 4. Don't sell. Don't dip into my portfolio to give me income. I'll find it somewhere else.
Yeah.
I mean, that was a real phenomenon, and it went on for 2 decades. Now they don't have to do that, but the worst version is, if 4% is great, what if I have a portfolio that averages 8%?
Yeah.
Yield.
I would also say, to the point that this gentleman in the article made, like, I think that for the most part, people aren't going all in on these products. I don't think anybody. I think most people are not like, this is 100% of my portfolio as I use these strategies that will deliver 160%. You know what I mean? I think people are being relatively sober about it. But
yeah, I think that's right.
But okay,
I think that's right.
Also, speaking of yields, Kevin Gordon. We're switching gears a little bit, but I just wanted to point this out. I didn't know where else to put it. Kevin Gordon tweeted, in the most recent week, money market fund assets increased by $121 billion, the most since March 2023, and before that, the most since April 2020. People just love yields, even if they're coming in. It's pretty remarkable.
So we talked about this, and I forgot where I saw this research, but legend has it, every time the Fed starts cutting rates, there's this weird phenomenon where money markets take in a ton of money at first.
Why is that?
My theory is it starts in money markets because people fund brokerage accounts, and then it leaves. So that my theory is people take money out of a savings account or a CD or something, and they load up their brokerage account, which adds to money market flows. But that money's just on the runway.
Yeah,
that's why you would have a 50 basis point cut in the Fed funds rate. Overnight rates come down 0.5%, and you see the assets soaring into money markets. That's people getting ready to do something different with their cash.
It's a reasonable hypothesis that cannot be proven or disproven.
Well, I just said it, so it's basically proven. Did you know that on the 10th, which is Thursday, is Tesla Robotaxi Day, 10/10. He almost did it on 8/8, but he wasn't ready. So now it's 10/10, and that's this week. And Barron's says, let's put this graphic up. Tesla Robotaxi Day is a make or break moment for Elon Musk. Before I even get into any detail, is that just like clickbaity?
Yeah, I was about to say, no, it's not.
That doesn't sound right, does it?
It's an important day. It's not make or break.
It's not make or break. And we know because the robot day with the person dancing around in a robot costume wasn't make or break.
Yeah. No, I'm not mad at the headline. It's okay.
What's at stake for Tesla on the 10/10 Robotaxi launch? So I wanted to mention a couple of things. He first teased it in April during a particularly nasty sell-off in Tesla. And a lot of the Elon haters have hypothesized that he just like makes these announcements to stop the stock from selling off. And then the engineers have to oh, what are we doing? So maybe there was some element of that here. So he said in April it'd be August, and now it's this week. I thought it was interesting that he's holding the event in Hollywood, California, which tells you how badly he wants mainstream attention on this, not just Tesla fans and not just like the tech media. Like he wants like Good Morning America to be paying attention. You understand? Like he despises California. He left. He's not a Hollywood guy. You wouldn't throw an event in Hollywood unless you really wanted to have a crossover splash. Let's take a look at the drawdown in Tesla shares right now. This is, I guess, why you could maybe say it's make or break. This is the worst of the Mag 7. It's in a 40% drawdown. It's been a pretty tough stock over the last couple of years. The company is doing fine. It's just not keeping up with the expectations. And then there's a lot of stuff that has nothing to do with Tesla that has infected the share price. Some of it's political, some of it's Twitter problems. So it's not been a lot of fun to be a Tesla shareholder.
The stock has sucked, and the business isn't doing great. They delivered as many vehicles this year as they did last year. That's not good.
Yeah, I guess. We have a chart showing Tesla versus the S&P and the rest of the Mag 7. Just to give you some sense, I think this is 1 year. So it's not catastrophic. It's down 8% over the last year. The problem is if you could have bought Meta instead, you would have doubled your money. Even if you just equal weighted the Mag 7, you'd be up 50%. And if you just bought the S&P, you'd be up 34%. So that's not, Tesla shareholders are accustomed to drawdowns. They're not accustomed to being outperformed to this extent by the rest of the stock market. I think that's a fair statement.
Yeah, the stock peaked in November of 2021. Yeah. And it had an incredible run in 2020. Did it go up 10x? Like literally?
Yeah. It might have been like one of the best single year performances of any stock ever, not just in percentage terms, but in dollar terms. It was out of control.
Yeah. So
Put up the table just real quick. This is this just gives you a sense of the Mag 7 performance, each stock, and then also the valuation. And here's what's interesting. Tesla is the worst performing of the Mag 7 over the last year and year to date, and it is far and away the most expensive. It's 77 times forward earnings, 455 times free cash flow. Earnings per share growth this year is minus 30%. The expectations for next year are plus 42%. It seems like that's not going to be easy.
Well, guess what? It doesn't matter, though, because look at the shareholder base. Like the valuation metrics for Tesla have never mattered. I find it hard to believe that they're going to start mattering tomorrow.
Okay. Here's what Barron's had to say. They're fairly skeptical about the self-driving business. Not the rollout might go great and the stock might have a huge rally, but they seem to be a little bit skeptical. Self-driving is getting closer to a reality, at least for Tesla's competitors. Waymo is completing 100,000 rides a week without a driver. Uber is adding self-driving cabs from Cruise while partnering with Waymo and investing in the NVIDIA-backed automated driving startup Wave, which almost nobody knows about. Tesla has taken its own path, rolling out incremental improvements to its driver assistance product called Full Self-Driving. Musk has hinted that other automakers are interested in Tesla's technology, but no concrete deals have emerged. So we don't know what they're going to come out with, but it's going to be some version of what they're already doing. And it's going to be like their way to turn a car into a taxi and have it be automated. There is a lot of progress being made by some of these competitors already, and the experts, like this guy Dan O'Dowd, thinks that Tesla's approach is just not going to work, and its performance is way behind. So here, the data set shows full self-driving completes roughly 90% of drives by itself, with drivers needing to take over every 100 miles or so. This guy, Dan O'Dowd, says not even close to acceptable. He says that performance is equivalent to rear-ending another driver once a month, and believes Tesla isn't close to solving autonomous driving.
Whoa. I don't understand. So 90% meaning that every 100 miles you have to take the wheel? That's not the same.
Yeah.
Okay.
Well, the Waymo doesn't have a driver. The Tesla FSD is more incremental, is what he's saying. And I can't weigh in on either side because I'm not an expert in this stuff. But this is a guy who has a business centered around like being an expert on this. So here, Tesla provides safety statistics that indicate that using Tesla's driver assistance technology lowers accident rates materially. The technology, however, requires drivers to pay attention 100% of the time. So if they have now advanced past that, where you don't need a driver, then we're in autonomous taxi time. And there seems to be a lot of doubt about whether they can really do that. So this is the reason why the stock's in a 40% drawdown for now. Losing share of the EV market. The EV market itself growing slower. Tesla is not a player in hybrid, which is the new hot thing.
Yeah.
Sales are slowing. Questions about full self-driving. Questions about competitive versus Waymo, Cruise, Wave, and all these other things. Then you've got the failure of Twitter financially, a massive exodus of users from the platform. You've got the write-down of the value by outside investors, which has nothing to do with Tesla, but it shows that Musk is not infallible. It's not a given that the Robotaxi will catch on or that their tech will be superior to anyone else's. The bull case is, how have things gone historically for people who have bet against Tesla?
Very poorly.
Or Elon Musk. Like, do you really think that he's run out of rabbits to pull out of a hat after all this time? You know, it's like too soon to like throw your cards down on the table and walk away if you're a shareholder. That's not been a great trade historically.
Well, until now. I mean, the stock is in a 40%
humiliates
drawdown.
people though.
But right now, the stock has not worked in a long time. Peaked in
2019. In 2019, he was cut in half, and the bears swore up and down that he was bankrupt.
Yeah.
and then the stock 10x'd. So I'm just saying he was sleeping in the manufacturing facility to turn that situation around. They were making cars in tents, and he pulled a rabbit out of the hat, and it's not completely out of the realm of possibility that he does it again.
No, I would not disagree with that. All right,
last thing on this. Many believe Tesla won't be able to live up to the hype around its robotaxi plans. Each robotaxi is expected to have a price tag of around $150,000 to $200,000, with some estimates suggesting Tesla would need $35 billion to develop a global fleet of such cars. With inflation and a lack of preference for electric cars as it is, a lot of American families are going to stay away from this robotaxi business.
Well, hold on. Let me ask you a question. So it's going to cost $150,000 to what, to purchase? But are they selling these? I thought they were just.
We don't know. The other thing is that these big events are not necessarily great catalysts for Tesla stock. It did pop 12% after they unveiled the Model 3 in March 2016, and that worked. It fell 16% after the 2022 AI event, where they had a prototype of a humanoid robot. The event they had before that in 21 had a person dancing in a robot suit. That was not a hit. So it's not like these events come and the stock is automatically a home run.
Yeah.
Apple doesn't go up on their launches either necessarily. So a lot of people are in this stock thinking it's an upside catalyst, and it might be, but that's not a slam dunk. All right, we're done with this.
Let's talk about the broadening of the rally. We're beating this dead horse, but it's important. We spoke a lot early in the year about the Mag 7 doing all of the heavy lifting, and yeah, it was. Look at this chart art from ChartKit. So for those listening, we have a top pane which is showing the S&P 500 year-to-date total return, and on the bottom we've got the Mag 7 contribution to the year-to-date total return. So the Mag 7 as a group collectively peaked in July, and at that point in time, they were responsible for roughly 12 of the 15 or so % return of the S&P 500. It was effectively all the Mag 7. Since then, you've seen the Mag 7 stall out, and oh my God, what is this? Is that the S&P 500 hitting an all-time high without participation, without leadership from the Mag 7? I think it is.
I think this could be like chart of the year candidate.
It's really
depending on how the year ends, showing the bifurcation. Like, all right, this was the first half, this was the second half. If this continues, this could be chart of the year.
Next chart.
I really like this.
So this is since the peak, and this is before today. So they had a good day. So whatever, it's a day old. But since that group peaked in July, the S&P is up 7%. I'm sorry, the S&P is up 1%. The equal weight, which is doing most of the heavy lifting, is up 7%, while the Mag 7 fell 6.5%. Pretty remarkable.
Yeah, this is pretty stark. People, look, I wanted to bring this up. One of the things going on with large cap tech, away from Tesla, these companies are getting their asses handed to them in courts all over the world. Particularly, the Justice Department in the United States is full speed ahead, and the European Commission is like winning. And I don't know what turns it around. Epic Games just beat Google in court on an antitrust case, and Google has this Android App Store monopoly, and the judge was sympathetic to Epic Games, which is Fortnite. And the judge ruled that for the next 3 years, Google cannot require developers to only use their in-app payment methods. The judge also ruled that Google had to stop trying to block the installation on Android devices of rival app stores. So they're making these payments to the carriers to like block the installs of like another app store so that you could buy things like Fortnite. And the judge just said stop. They're going to appeal it, and it'll go on for another 3 years. But I'm just saying, like, these are starting to weigh on the valuations of these companies. Apple is going to have a fight for its life at some point. The Justice Department might win its antitrust case against Apple. They're saying the iPhone unlawfully maintains its monopoly by controlling the distribution and creation of apps through its rigid App Store rules. Apple is already on the defensive of its App Store practices. This is coming from Martin Pierce at The Information. Google already lost the search antitrust case the DOJ brought, where they're paying Apple to be the default search engine. It's like billions and billions of dollars to block any other search engines from being on the phone as the default search. So there's a lot of things going on with these large stocks that like headline risk in court, and that's not going to stop anytime soon. So that's one reason why I think people are just looking elsewhere and they're not only allocating to these names. We have this from Todd. Let's do these really quickly. This is the small cap bull market. So far, underwhelming relative to previous bull markets for small caps. So if this one started 10/12/2022, we're up about 30%, which sounds great, until I tell you that the average Russell 2000 run during a bull market for small caps is 77%. So you could take that either way. You could say it's a sign of weakness, or you could say, oh, look how much room we have.
Yeah.
I don't know. Which side would you fall on there?
Both.
Okay. Next one. Todd shows that it's a low bar. We're still trailing the average move off the low for the Russell 2000. So they're showing you the performance 1 year off of a major low, and they're using the 2023 major low in this case. So we're about 240 days since then. And as you can see, this blue line is below average and obviously below some of the biggest small cap rallies ever.
How about this? We said earlier, what happens if the Fed pauses? We're thinking through the prism of the S&P. If the Fed pauses, the small caps get killed.
Yeah. Victim number one is like community banks, and the Russell itself won't be very far behind.
Yeah.
They'll whack all these stocks. I agree. Pfizer is an activist. Are you excited about this?
No.
Okay. I am. I've been trapped in the stock for a year. It hasn't done anything. I haven't lost any money, but I haven't made any money. Starboard Value is legit as fuck. Are you familiar with their game?
A little bit.
Okay. If you were, I would have gotten a much bigger reaction out of you.
I mean, the market's not excited, so I'm not excited.
The market is not wrong. The market is not wrong. There are a lot of challenges here, but the market, like the Fed, needs to see through real estate and shelter costs. The market needs to see through the near-term challenges with Pfizer and understand that this activist is the company that literally turned around the Olive Garden. These guys do not play games. Starboard Value, let's start with Pfizer. The problems, they're fixable. Their M&A strategy has been all over the map. They bought a whole bunch of stuff that strategically doesn't make sense. That could be fixed on a dime. The giant bet on COVID we know about. There's nothing you do about it now. Pfizer within the XLV, there are 62 stocks. It's the 24th worst performing XLV stock year to date. It's only up 1.5%. It's the 7th worst performing XLV stock over the last year, down 12%. Within the S&P 500, 142nd worst performer, 38th over the last year. Let me show you the 3-year versus the competitors.
Not great.
Pfizer is that garbage purple line at the very bottom. 3 years, negative 22%. Eli Lilly is the big winner, orange, because they're making fat people skinny overnight. It's like kind of miraculous. Anyway, Starboard's latest activist campaign almost tripled the share price of Salesforce. Chart, please. Dude, you want to know where they came in? October of 2022. And they laid out their plan in January of 23. Do you think it worked?
How do you know it would have not worked without them? I don't know.
I'm pretty sure because they were demanding significant cost cuts, and they took an initial stake, and then they added, and they added.
You know what else bottomed in October 2022?
Yeah.
The market.
Doesn't matter. Salesforce laid off 10% of its workforce. They committed to improving their operating margins by 25%, and they appointed new board members, and this thing literally worked. They turned around Darden. Stock price gained 60%, seen as one of their biggest winners. They lost a proxy battle with AOL in 2012, but they still managed to make a lot of money. Office Depot Advanced Auto Parts, ACOM, Corteva, Mellanox, Symantec. These are all companies where they either got board seats or they got the attention of the management and got a big turnaround for shareholders. They bought $1 billion worth of Pfizer, and that's not a huge stake relative to the market cap, but it's also not nothing. And I'm pretty sure the expectations here are so low that even modest improvements could take the stock significantly higher. So, shout to Starboard. Welcome to the shit show.
You know what activist I like better? The guy last week who was Larry. What's the guy from CVS? Which, by the way, stock is closing the gap.
Larry Robbins.
Stock is closing the gap that we spoke about.
Robbins.
You know what else we spoke about last week? But that did not work. So we mentioned CVS closing the gap. That's in progress. We spoke about NVIDIA clearly putting it a higher low. Invalidated.
Bang.
Invalidated.
Yeah, it's fine.
I'm sorry, a lower high. My bad, a lower high.
Yeah, it's fine. $3 trillion.
Yeah, there it goes.
Bigger than Microsoft today.
Is it back to number one?
Number two.
What?
Only
Apple.
Only Apple.
Yeah.
And not by much.
Yeah.
And not by much.
All right, let's do some bank stuff. All right. Look at this chart from ChartKit. So the big thick blue line is the S&P 500, and above or below are the industry groups within financials. So the best performer is consumer finance. Those are
Well done.
Thank you. I felt like that was the appropriate time to say it. Those are the credit cards for the most part. You've got insurance absolutely ripping, banks performing well, capital markets are coming up the rear. We're going to get to that later. So yeah, what did I say? Yeah, that's American Express, Capital One, and Discovery. So it's been a good year for the banks. Next chart, please. So within the banks sector specifically, these are the banks that are winning: M&T, Citizens, J.P. Morgan. Underperforming the S&P are some of the others: U.S. Bancorp, Truist, Wells Fargo, et cetera, whatever. But let's get into what the market is expecting. So this, I believe, is from FactSet. The financial sector is predicted to report a year-over-year earnings decline of 0.4%. However, the bank industry is the only industry in the sector that is expected to report a year-over-year decline of earnings at negative 12%. So most of the decline in earnings estimates are coming from banks, which is the largest sector within financials. If banks were excluded, the estimated earnings growth rate for the financial sector would improve to 6.9%.
Yeah, if you pull out the banks, everything else in finance is actually growing to varying degrees.
And what's expected to report the highest earnings growth of the five industries in the sector is capital markets at 11%.
Yeah.
So those stocks are really, really working.
So that's banking and brokerage, so Wall Street stuff, financial exchanges and data, that's CME, NASDAQ, and then asset management and custody banks, which is like Ares and Blackstone. All those stocks are
Goldman, Moody's, Morgan, MSCI.
Throw up the chart. This is really illustrative. So the banks themselves is obviously that final bar that you see is negative 12% earnings growth year over year, which is what we're expecting for this quarter. Mike, I think that's the good news. That expectations are really low.
And also, I feel like I might be wrong, but I feel like there's not usually big surprises either way with banks, right? It's not like they were expected to grow at 1% and they actually shrank by 4%. These aren't like very, very volatile.
You know where
groups.
The surprises come from? Trading and fixed income currency, like FIC and trading is like where like that big variation from the expectations comes, because that's a function of like when they decide they want to take a gain or a loss, and the Wall Street doesn't give the banks any credit on giant trading gains, because Wall Street understands that that's easy come, easy go. So like you do get like big misses and beats, but then when you hear the explanation and you're like, wait, Goldman just beat by 80 cents. Why isn't the stock moving higher? Well, because it's coming from this honeypot of trading gains and losses, and they don't get credit for it in the multiple because nobody thinks
they're temporary.
Yeah, it's temporary. That's exactly right. what they get credit for really is NIM, so net interest margin, very basic, how much they're making on their loans. And then they'll get credit for like for when they are able to drop reserves back down into earnings, meaning that they've been good lenders. And
well, that's going to happen because they took a lot of loss provisions that probably did not come to fruition.
That's
like
right.
they've been aggressive. And then what we're also going to hear from JP Morgan, I'm guessing, is a very bearish Jamie Dimon, which is par for the course.
You know what? I thought that, but he did a Bloomberg hit today. He did 15 minutes with Bloomberg, and none of that doom and gloom shit. It was about the IPO market is coming back.
Okay.
We don't know when, but we think it will. There are some structural reasons for why these companies are not in a rush to go public, but eventually there's enough pressure that they need the liquidity, and it's going to happen. He was like sort of upbeat about that. And he also decided not to endorse either presidential candidate this time.
What did he do last time? I don't remember.
He's a no Trump guy.
Got it.
But he's not doing that this time. And what else did he say? He said one other thing that I thought was interesting. But he was not like this is going to end badly. He wasn't doing that. So
okay. Good to see. Well, we'll see what he says on the call. All right, that brings us to make the case. I'm going to keep this fairly boring. I'm gonna remake the case for a couple of names that we've spoken about a lot lately. One of them happens to be in capital markets. And the reason why I'm making the case for these names is because they continue to work. They've all had great runs.
Ain't nothing wrong with that. You don't have to have a new idea every day.
They're consolidating. They gave back a little bit. They're hanging high. Like technically, these names are, I don't want to say flawless, but like I don't know what else to call them. They look really good. So we got some charts. Chart on, please, John. So the first one, I do own this one, SPGI. This is S&P Global. It continues to work, hang higher, not giving much back. Next one, I think, is ICE. There's that. So that looks pretty damn good as well. And the last one, I don't own, Josh, you do. This is NASDAQ.
They all look the same.
They're all working.
Yeah, I think they're stock market proxies, basically, at this point.
Meaning what?
Overlay those charts with the stock market. I think there's like now a very high correlation. I think like higher stock market, higher stock market, higher interest rates, or excuse me, higher stock market, higher activity in the stock market and in the bond market. These companies do well. Like they don't need endless rallies, but they help.
Well, a lot of the derivative stuff is certainly is filtering into ICE, for example. All right, one more group of stocks that is working well. And it's interesting because you would think, at least I would think, hold on, chart off please for a second. I would have thought that the recent economic strength and the likelihood of less rate cuts, I would have thought that would have been bearish for these stocks. And the opposite was true, which means that, I don't know, unless the market is wrong, this is pretty bullish. So I own these three names. So first up, Home Depot. Not quite at an all-time high, but very, very close. The next one is, I believe, Sherwin-Williams, a stock that I've pitched here, continuing to hang high. And then last but not least is Williams-Sonoma. These are all working to varying degrees. And if the housing market unfreezes, these should continue to do well, unless it's all being priced in, and we'll find out in a couple of months.
So those three stocks, think about the backdrop. Rates are coming down, which should lead to increased housing turnover to some extent, which favors Sherwin-Williams, favors Home Depot, favors Williams-Sonoma. What do you do after you buy a house? You repaint it. You go to Home Depot and change some doorknobs or whatever the fuck. And you go to Williams-Sonoma and you buy like a gigantic rolling pin that you'll never use, and maybe one of those bread things in the big silver bowl.
Yeah,
you're going to use it twice.
Yeah.
But that's what you do when you buy a house. So that makes perfect sense to me. I want to show you my mystery chart, and then we'll get out of here. John, if you please. All right, dude.
All right,
Don't let me down.
Okay.
The yellow stock was once a wholly owned subsidiary of
I know
the
what this
purple
is.
stock.
It's PayPal and eBay.
I love you. Give me the reveal. Both of these stocks are on fire right now. Both of these stocks are breaking 52-week highs. Both of them have a turnaround story. The eBay one is a little bit more boring, but matters the most to me because I pitched it to Al Michaels. The PayPal one I actually bought.
What's going on with eBay?
It's on fire. Did you with eBay? It's 10 times earnings, and all they need is a slight uptick in revenue.
All right, so the answer is you don't know what's going on with PayPal.
No, that's the story. It's cheap enough that nothing has to be going on with it.
Okay.
You understand?
No.
10 times earnings. What else?
I mean, dude, a lot of businesses trade for 10 times earnings.
Internet businesses? Not really.
Okay.
PayPal. Did you watch my conversation yesterday with Dan Dolev? It was pretty great. He looks like you too. He was like a proxy for you, but he covers fintech, and we did like 20 minutes on PayPal. He loves the new CEO. He thinks they're going to get bigger. They got a big deal with Amazon. He thinks it's going to expand. And he's not ruling out the possibility of a Venmo Apple pay with Venmo on the iPhone. So he's bullish PayPal.
Can you do that already? Can you do that?
No, NFC chip like tap.
Oh.
Yeah. Pay with Venmo, bro. There's 65 million Venmo users. It's U.S. only. He also thinks that Venmo could go international because PayPal's international, and there's a lot of shit going on there. All right. So the mystery charts are you nailed it on the first guess. I guess there's nothing left to say. I want to remind everybody tomorrow is Wednesday, which means as soon as you wake up, freshly squeezed episode of Michael and Ben on animal spirits on the podcast app of your choice. I also want to tell you guys as a programming note, Ben and Duncan moved Ask the Compound to Wednesday afternoon. So if you have a personal finance question, a financial planning question, an asset allocation question, and you want Ben and Duncan to answer it live on the show, let's be honest, mostly Ben, the best way to submit that is asktheCompoundShow@gmail.com. And then stick around for later in the week. Jill will be back. Michael and I will be back with a new guest on The Compound and Friends. And keep it locked here, and we're going to keep delivering. Thank you guys so much. Have a great night.